The Engines of Tomorrow, a comprehensive guide to iShares Core MSCI Emerging Markets ETF, IEMG. As of January 26, 2026, the iShares Core MSCI Emerging Markets ETF, ticker IEMG, has emerged as the premier vehicle for investors seeking to move beyond the saturated markets of the United States and Europe. After a blockbuster 2025, in which emerging markets, EM, outpaced the S&P 500 with a rally exceeding 30%, IEMG has become a must-watch for those looking to capitalize on the next leg of the global AI boom and the structural shift in global trade. For an investor today, IEMG is not just a collection of developing stocks. It is a high-growth engine powered by the world's most advanced semiconductor labs in Taiwan, the tech giants of China, and the resilient financial institutions of India and Brazil. This guide explores why IEMG is a cornerstone of the modern portfolio, the South Korea factor that sets it apart, and the specific geopolitical risks that make it a high-volatility play. 1. What is IEMG? The core of international growth. IEMG is designed to provide comprehensive, low-cost access to the entire investable market of emerging economies. Unlike older funds that only look at massive, mega-cap companies, IEMG includes large, mid, and small-cap stocks. The mechanics of the fund. The index. It tracks the MSCI Emerging Markets Investable Market Index, IMI. By including small-cap companies, IEMG offers a more authentic exposure to the local growth of these economies than funds that only hold a few hundred giant exporters. Diversification Scale. As of early 2026, the fund holds approximately 2,700 different stocks across 24 countries. This massive scale ensures that if one company or even one small country faces a crisis, the overall impact on your portfolio is diluted. Passive efficiency. Like other core iShares products, IEMG is passively managed. It doesn't try to outguess the market, it simply owns the market. This keeps costs at an absolute minimum. 2. The 2026 strategy, the AI and energy tailwinds. The primary reason IEMG is dominating headlines in January 2026 is its heavy exposure to the physical infrastructure of the 21st century. The semiconductor powerhouse. Nearly 28% of the fund is currently allocated to the information technology sector. Taiwan Semiconductor, TSMC, with a weighting of over 10%, TSMC is the fund's largest holding. In 2026, as AI hardware demands reach a fever pitch, TSMC remains the sole provider of the advanced chips required by NVIDIA and Apple. South Korea's AI surge. Unlike some competitors like Vanguard's VWO, IEMG includes South Korea as an emerging market. This gives investors heavy exposure to Samsung Electronics and SK Hynix, the world leaders in high bandwidth memory, HBM, which is the fuel for AI servers. The nearshoring beneficiaries. As the US and China continue to de-risk their trade relationship, countries like Mexico and India, which make up significant portions of IEMG, are seeing record-high foreign direct investment. India's stock market, in particular, has become a global darling in 2026 as its domestic middle class expands and its manufacturing sector begins to rival China's in scale. 3. Financial profile. Low cost, high potential. For the retail investor, IEMG is often the math-driven choice because of its efficiency. Key performance metrics, January 2026. Expense ratio, 0.09%. This is incredibly low for international investing. For every $10,000 you invest, BlackRock takes only $9 per year. In contrast, actively managed EM funds often charge 1% or more. 2025 total return. The fund returned approximately 32.1% in 2025, driven by the tech-led recovery in China and the AI-driven breakouts in Taiwan and South Korea. Dividend yield, 2.8%. IEMG pays out dividends semi-annually. While people buy EM for growth, a nearly 3% yield provides a nice buffer during flat market years. Assets under management, AUM, with over $135 billion in the fund, IEMG is highly liquid. You can buy or sell millions of dollars worth of shares instantly with a very small spread, the difference between the buy and sell price. 4. IEMG versus VWO, the great debate of 2026. If you are looking at IEMG, you will inevitably see the Vanguard FTSE Emerging Markets ETF, VWO. In 2026, the choice between them comes down to one country, South Korea. The FTSE View, VWO. Vanguard follows the FTSE Index, which classifies South Korea as a developed market, like Japan or Germany. Therefore, VWO has 0% exposure to Samsung or SK Hynix. The MSCI View, IEMG. MSCI still considers South Korea emerging due to certain currency trading restrictions. The verdict. In a world dominated by the AI cycle, most investors in 2026 are leaning toward IEMG specifically to capture the massive growth of the South Korean tech sector. If you want a purer play on smaller developing nations, VWO is the choice. If you want the tech leaders of Asia, IEMG is the winner. 5. Critical risks, the anti-EM case. Investing in emerging markets is not for the faint of heart. The higher potential returns come with significantly higher risks than a safe fund like VOO. Geopolitical friction. A significant portion of IEMG is tied to the Greater China region, China and Taiwan. Any escalation in cross-strait tensions could lead to gap-down pricing, where the fund loses 10 to 20% of its value overnight as investors flee to safety. Currency volatility. IEMG's holdings are priced in local currencies, yuan, won, rial, rupee. If the US dollar remains exceptionally strong in 2026, it eats into your returns. Even if a Brazilian stock goes up 10%, if the real drops 10% against the dollar, your return as a US investor is zero. Governance and transparency. While IEMG holds over 2,700 stocks, many are in countries with less stringent accounting rules than the US. Accounting scandals or sudden government regulatory crackdowns, as seen in the Chinese tech sector in 2021, are a constant threat. High beta. IEMG typically has a beta of around 1.2 to 1.5 relative to the S&P 500. This means when the US market drops 10%, IEMG will often drop 15%. It is a risk-on asset that requires a long-term horizon. 6. Investment strategy. How to build your global allocation. In early 2026, financial advisors are generally recommending a 10-20-70 split for aggressive growth portfolios. 70% US core, like VOO, the bedrock of stability. 20% developed international, like EFA, exposure to Europe and Japan. 10% emerging markets, IEMG, the high-octane growth kicker. The rebalancing trick. Because IEMG is so volatile, it is the perfect candidate for annual rebalancing. If IEMG has a massive year like 2025 and grows to 15% of your portfolio, sell the extra 5% and move it back into your safer US funds. This forces you to sell high and ensures your risk doesn't get out of control. Conclusion. The diversifier of choice for 2026. The iShares Core MSCI Emerging Markets ETF, IEMG, is currently the most efficient way to bet on the rise of the rest. It offers a rare combination of rock-bottom fees and exposure to the most exciting technological and demographic trends on the planet. While the risks of China and currency swings remain ever-present, the 2026 outlook for EMs is the strongest it has been in a decade. The verdict. If you believe that the global economy is becoming multipolar and that the next billion internet users and the world's AI hardware will come from the East, IEMG is an essential tool. It is the growth engine that your portfolio needs to stay ahead of inflation and domestic stagnation.